This legislation is working its way through Congress. What they're trying to do here is have this 2-year extension on the Bush tax cuts, therefore keeping the 35% maximum rate in place. If they were not to do that, it would reset to the pre-Bush era rates, which would be 39.6. So, there is a benefit to that. Another item that is on this legislation is the reinstatement of the estate tax with a $5 million exemption and a 35% top tax rate. Currently, I don't know if anybody of you have been involved in this, but currently there is no federal estate tax. So there's no limit, there's no tax at the federal level. There's discussion about a 2-year AMT patch, as they refer to it. If anybody has worked through the alternative minimum tax form, which is pretty complicated, but there's an exemption that you get, and currently that's about $75,000 for married filing jointly. If that were to reset, in other words, they weren't to address this, it would go down to about $47,000. So that's a big difference, and then obviously times the AMT tax. There are 3 new things in this legislation, things that don't relate to the Bush tax cuts. When I say new, there's many new things that are obviously not even being addressed here. And that is allowing businesses to write off 100% of their equipment and machinery purchases in 2011. This would be we're not quite sure what this really means, but the thinking is this would fall in the lines with the Section 179 deduction, which allows you to write off. It's changed over the years. There's certain limits. Right now for 2010 it's $500,000, but with the way the law is currently written in a Section 179, you cannot generate a loss with a Section 179 deduction, meaning writing off of assets in the current year. So we're not sure how this is going to play out. I guess we'll kind of have to stay tuned and see how this is addressed in the new law. Another item that's new is reducing the worker's share of the Social Security. There's also been discussion about extending the unemployment benefits for 13 months for those that are who are still looking. Next item I want to talk about is what's called the HIRE Act. This was signed by the President on March 18th, 2010. And basically, this is intended to encourage employers out there to hire the unemployed. Another way to try to spur the economy as well as reduce the unemployment. And there's really 2 parts to this act, I guess. There is, to be a qualified employer, one of these people that you hire, they cannot have worked for more than 40 hours in the past 60 days. And that's not 40 hours per week, that's 40 hours total. So obviously this is someone that has been unemployed, maybe held some odd jobs, and hasn't worked a whole lot in 60 days. There's a part 2 to this act, and that's what's called a tax credit. Credits are great because credits, as everybody hopefully knows, is a dollar-for-dollar benefit to you. It's 100%, whereas the deduction is going to be then multiplied by your tax rate, whatever that happens to be, maybe get a 30–40% benefit. This is obviously 100% benefit. With the tax credit, you get $1,000 per worker, meaning one of these qualified employees that you hire that meet the requirements. And you would get $1,000 for each worker, assuming they were to be still employed by you 52 weeks or a year later. Obviously, looking at the dates of all this, this is a deduction, a credit that you would get benefit for in 20. My next slide here has to do with the qualified high-tech company credit. And what this is a reduction. There's, let me back up a minute. It's basically, this came into being, it's a collection of incentives that were reducing the cost of doing business, a high-tech business in D.C. And the reduction, if you're one of these high-tech companies, they reduce the franchise tax, which is roughly 10%, to 6%. If you're one of these high-tech companies that's also in a high-tech zone, and there's various places within the city that you have to reside, meaning have your employment, then you will get a 5-year abatement on the tax, the franchise tax, obviously the year after you come into business. There's also a partial benefit or for your personal property tax. If you were to have qualified tangible personal property that you buy, this high-tech company, there is a exemption from DC tax for 10 years. There's some exemptions for sales and use tax in this law. There's also a deduction for Section 179 expenses. As I mentioned earlier, Section 179 as many of you may know, if you have since DC businesses, DC is one of the well, let's call it it's not a state, but one of the entity or states that decouples. Basically, they don't follow federal. So in DC, you're not allowed, if you took a Section 179, meaning wrote off your equipment, let's say you bought $40,000 of equipment, and federally you got that deduction, you're not going to get that for DC. They're going to make you reschedule that asset and depreciate it over other methods. In other words, reducing that deduction and increasing your taxable income. So in this particular case, they're going to give you the first $40,000. There's also some wage and relocation reimbursements built into this law. Those have to do with qualified employees that work 35 or more hours a week, and if they relocate to your employment in DC as one of these high-tech companies, there's a $5,000 credit for these employees who relocate their employment from outside of DC into DC. And then if they actually do that as well as change their residence from outside of DC into DC, there's a $7,500. The enterprise zone employment tax credit. Now this is a federal credit. This is a credit, not a deduction, as it says, so you'll get 100% benefit. And the way this works is it's up to $3,000 per, once again, qualified employee. This would be someone that you know, works within DC and you know, for the DC employer. And this is the way you calculate this is the credit's up to $3,000 or 50% of their wages. Excuse me, 20% of their wages, up to $3,000. It's the lesser thereof. And they have to be live in the DC. They do not have to live in the enterprise zone. They can live anywhere in the city, but the employer would get this benefit. The domestic production activities deduction, once again, is a deduction, not a credit. This is one that you may or may not have heard about. It primarily relates to those in construction, contractors, people that are doing renovations or construction, home builders, etc. In the U.S. There are some complications. It does require or involve some special bookkeeping and accounting where you have to track your U.S. sales and related cost of sales and expenses. You have to bifurcate or segregate those out if you have multiple lines of business. So it involves a lot of work in many cases, or at least in the early years, for the benefit that you got.